Disclaimer.
Today, Monday, January 19th, 2026, while most of America enjoys a quiet holiday, unaware, a financial earthquake has just ruptured the global silver market. If you're looking at your screen, seeing silver at $90 or even $100 an ounce, let me be brutally clear. You're looking at a ghost. The price on your screen is a lie. What's unfolding in the shadows during this 24-hour blackout is not mere volatility. It is the full thermal detonation of the paper silver market. We have entered a phase historians will call the Great Repricing. And by the end of this week, I'm going to prove that $485 an ounce is not a gold bug fantasy, but the inevitable mathematical conclusion. The signs were there if you knew where to look. Just days ago, two Chinese companies called a Canadian silver mining executive on the same Friday afternoon. Both offered to pay $8 above market price for physical silver. One was a manufacturer desperate for supply. The other was a trading firm scrambling to secure inventory before something changed forever. By Monday morning, an Indian buyer contacted the same executive. Their offer? $10 above spot price for immediate delivery. No negotiations. When buyers start paying massive premiums for physical metal while the paper price suggests everything is normal, you're witnessing the early moments of a market breaking in real time. And most investors have no idea it's happening. Here's what Wall Street won't tell you about those phone calls. They weren't random. They were symptoms of a supply chain fracturing between two worlds. Those who actually hold physical silver, and those who merely hold promises of silver they can no longer deliver. On January 1st, China quietly implemented export licensing requirements for refined silver. Not a complete ban, but strategic restrictions that effectively removed somewhere between 60 and 70% of global refined supply from open markets. Think about that number for a moment. Not 10%, not 20%. The majority of the world's refined silver supply just disappeared behind government licensing requirements. China doesn't just mine silver, they refine most of the world's supply. When you purchase a silver coin in Denver or a silver bar in London, there's an overwhelming chance that metal passed through Chinese refineries at some point in its journey. Those refineries are still operating, still producing, but they're no longer freely selling to Western markets. The metal isn't vanishing, it's being redirected. And the phone calls that Canadian mining executive received? Those were the sound of panic spreading through global industrial supply chains as companies realized the old rules no longer apply. While this was unfolding, every major Wall Street analyst was busy updating their silver price forecasts. Goldman Sachs raised their year-end target to $38 per ounce. Bank of America pushed theirs to $56. The consensus formed around a simple question. Could silver possibly break through $100 by year's end? But here's the problem with their forecasts. Every single projection assumes Chinese supply continues flowing west. Every model assumes the paper markets controlling silver prices for decades can continue operating as they always have. Every target price is built on assumptions that became obsolete the moment those export licensing requirements took effect. Let me show you what's really happening beneath the surface of our markets, because the numbers reveal a system on the edge of collapse. The COMEX in New York holds the primary exchange where silver futures trade. According to data compiled by precious metals analysts, that exchange currently maintains about 270 million ounces of silver in its registered vaults available for delivery. That sounds substantial until you realize there are 96 billion ounces worth of paper claims trading against that physical inventory. The math creates a paper-to-physical ratio of 356 to 1. Read that again, slowly. For every single physical ounce sitting in a COMEX vault ready for delivery, there are 356 paper contracts claiming ownership of silver. These aren't all demanding immediate delivery, but they represent promises, derivatives, and financial instruments all backed by one critical assumption, that physical silver will be available when needed. That assumption is about to be tested in ways the market hasn't experienced in decades. Now here's where this becomes personal for anyone holding silver investments or considering them. Those COMEX inventories I just mentioned, according to exchange data, they're down 70% since 2020. We've gone from over 900 million ounces in registered inventory to roughly 270 million today. The metal is leaving the vaults faster than it's being replenished. And with Chinese exports now restricted, that replenishment rate just collapsed. You know what happens when 356 people hold claim tickets for the same parking space? Nothing, as long as they don't all show up at once. But the moment a significant number try to claim their spot simultaneously, the entire illusion shatters. We're watching that moment approach in real time, and most investors are still debating whether silver might hit $100 this year. The first cracks are already visible if you know where to look. In Shanghai, silver trades at a $10 premium above Western spot prices. Let me put that in perspective for you. Normally, prices between major markets stay within pennies of each other because arbitrage traders instantly exploit any gap larger than transaction costs. When you see a sustained $10 premium for weeks, It means the normal mechanisms equalizing global prices have fundamentally broken down. Shanghai buyers are paying $10 more per ounce than New York buyers, and they're still buying aggressively. Why? Because they can't get the metal from New York anymore. The flow has stopped. Chinese industrial users, investors, and institutions are competing for domestic supply, and they're willing to pay extraordinary premiums because importing from the West is no longer a reliable option. But here's the signal that should grab everyone's attention immediately. Silver lease rates just spiked to 8%. According to the London Bullion Market Association, rates this elevated haven't been seen since supply disruptions in the early 2000s. If you're not familiar with lease rates, let me explain why this matters so much. When banks and institutions need physical silver for short-term needs, they can lease it from other holders rather than buying outright. Normally, silver lease rates hover near zero because there's always plenty of supply available. An 8% lease rate means institutions are desperate for physical metal and willing to pay extraordinarily high costs to borrow it temporarily. When lease rates spike, it signals one thing clearly. Those who promised to deliver physical silver are now scrambling to find it. The confident assurances they gave to clients about delivery, those assurances were based on access to Chinese supply that no longer exists. But think about your own investment portfolio for a moment. If you own silver ETFs, do you actually own metal, or do you own a promise to receive metal from an institution that might not be able to source it? If you hold futures contracts, are you positioned to take physical delivery, or are you betting on price movements in a paper market increasingly disconnected from physical reality? These distinctions didn't matter much when Chinese refineries flooded global markets with supply. They matter enormously now. The global supply chain for silver is fracturing into two distinct markets right before our eyes. There are those who physically hold metal in allocated storage, and there are those who hold paper promises from institutions who thought they could always source metal when needed. We are about to discover which category matters when supply constraints hit a system built on leverage and promises. Wall Street analysts setting $100 targets are doing what they've always done. They're extrapolating recent trends, adjusting for inflation expectations, maybe adding a premium for industrial demand growth. Their models assume markets function normally. They assume supply responds to price signals the way economics textbooks describe. They assume paper and physical silver remain interchangeable, but normal market dynamics depend on fluid supply chains and available inventory. When 60 to 70% of refined supply disappears behind export controls, when vault inventories drop 70% while paper claims multiply, when Shanghai pays $10 premiums and lease rates hit 8%, these aren't normal market conditions anymore. These are the conditions that precede a repricing event. Not a gradual climb to $100 that analysts can predict with their spreadsheets and trend lines. A repricing happens when markets suddenly realize the old price discovery mechanism has broken, when the gap between paper promises and physical reality becomes too large to ignore, when the assumptions underpinning decades of price suppression collapse all at once. You're watching the early stages of that collapse right now. The question isn't whether silver will hit $100. The question is what happens when 100 becomes the floor, not the ceiling. Because the paper markets that kept prices suppressed for so long simply cannot deliver physical metal at any price Wall Street considers reasonable. China didn't announce these export restrictions with fanfare or press conferences. They implemented them quietly, bureaucratically, as part of broader strategic resource controls, covering tungsten, antimony, and other critical materials. Most Western investors haven't even noticed yet. Financial media is still focused on whether we'll see triple-digit silver by December. Meanwhile, the physical market is telling a completely different story. Industrial users are paying massive premiums for immediate delivery. Lease rates are screaming that physical metal has become scarce. Vault inventories are draining while paper claims multiply. And somewhere in Canada, a mining executive is fielding calls from desperate buyers willing to pay whatever it takes to secure physical silver before the rest of the market realizes what's happening. That story is just beginning, and the next chapter involves numbers that make $100 per ounce look quaint. Let me show you the math that Wall Street doesn't want you to see. For the past 5 consecutive years, global silver demand has exceeded total supply. Not by small margins, not by amounts that could be covered through normal market adjustments. According to data from the Silver Institute, we're talking about a cumulative deficit totaling 820 million ounces over those 5 years. To put that number in perspective, global mine supply produces roughly 800 million ounces annually. We've consumed an entire year's worth of global mining production beyond what mines actually delivered. That silver had to come from somewhere, and it came from above-ground stockpiles that took decades to accumulate. Those stockpiles are now largely depleted. In 2025, just added another 160 to 200 million ounces to that deficit. Now, here's where it gets interesting. When markets face supply deficits, prices typically rise. until demand decreases or new supply comes online. Economics textbooks call this equilibrium, except silver isn't following the textbook anymore because the demand isn't discretionary. It's structural. It's locked into industrial processes that cannot simply reduce consumption when prices rise. Take solar panels as an example. According to research from Wood Mackenzie, solar manufacturing now consumes roughly 25% of annual silver production. Every solar panel requires silver paste for photovoltaic cells because silver is the most electrically conductive metal on Earth. There is no substitute that works as efficiently. None. Imagine you're a solar manufacturer in Arizona planning your production for the next quarter. Your panels require a specific amount of silver per unit. When silver prices rise, you can't just decide to use less silver or switch to a different metal. The physics don't change because economics became inconvenient. You either pay the higher price for silver, or you shut down production and breach contracts with customers who've already committed billions to solar installations. This is why industrial demand for silver has become completely inelastic. Solar installations are projected to grow dramatically over the next decade as countries race to meet climate commitments. Electric vehicles require silver in their charging systems and electronic components. 5G infrastructure depends on silver in its circuitry. Medical devices use silver's antimicrobial properties in ways that can't be substituted without lengthy regulatory approval processes. You're not dealing with jewelry demand that can shrink when prices rise. You're dealing with technological infrastructure that nations view as strategic priorities. These industries will pay whatever silver costs, because not having silver means not building the technology that defines economic competitiveness in the 21st century. Now let's talk about supply, because this is where the situation becomes truly dire. You might be thinking, well, if silver prices are rising, won't mining companies just produce more silver to meet demand? That's the logical assumption. It's also completely wrong. Here's what most people don't understand about silver mining. According to data from the World Silver Survey, roughly 71% of silver production comes as a byproduct from copper, zinc, and lead mining operations. Read that again. Nearly 3/4 of the world's silver isn't mined intentionally. It's extracted incidentally while mining for other metals. What does this mean in practical terms? It means silver supply is tied to the economics and geology of completely different commodities. A copper mining company in Chile doesn't increase production because silver prices doubled. They increase production based on copper demand and copper prices. The silver they produce is essentially a bonus that helps offset costs, but it's not the primary driver of their operations. Think about trying to solve a silver shortage when most of your supply depends on the operational decisions of copper, zinc, and lead producers who aren't even focused on silver markets. It's like trying to increase milk production by convincing dairy farmers to breed more cows, except the farmers are actually in the beef business and milk is just something they sell on the side. Even for primary silver producers who mine silver intentionally, ramping up production isn't a matter of flipping a switch. According to mining industry analysis, developing a new silver mine from discovery to production requires 8 to 12 years on average. That timeline includes exploration, feasibility studies, environmental permitting, securing financing, construction, and commissioning. We're not talking about increasing production next quarter or even next year. We're talking about a decade-plus timeline to bring meaningful new supply online. And here's the kicker. Most easy-to-access silver deposits have already been discovered and mined. New discoveries are increasingly in remote locations, deeper underground, or in geologically challenging environments that make extraction exponentially more expensive. Mexico, which produces roughly 23% of global silver supply according to the U.S. Geological Survey, is facing its own supply challenges. Fresnillo, the country's largest silver producer, recently announced production shutdowns at portions of the San Julian mine due to operational issues. That's not a small operation we're talking about. That's a major producer taking supply offline in the middle of a global shortage. Russia, another significant producer, is now facing comprehensive Western sanctions that complicate silver exports even when they have metal to sell. Sanctions don't make the silver disappear, but they create friction, delays, and uncertainty that further constrain global supply chains already stressed beyond their limits. Meanwhile, our own domestic mining operations face regulatory hurdles, environmental challenges, and infrastructure constraints that slow production expansion. This isn't about politics or environmental policy. It's about acknowledging the reality that increasing silver supply in a meaningful time frame is essentially impossible given current constraints. Now, let me show you something that should make every investor pay attention. While all of this was unfolding in silver markets, something significant was happening in gold. According to World Gold Council data, central banks globally added over 1,000 tons of gold to their reserves annually for 4 consecutive years. Think about what that means. Central banks don't buy gold for investment returns. They buy gold as a strategic reserve asset, a hedge against currency instability, and a store of value independent of any nation's fiscal policy. When central banks worldwide engage in coordinated gold accumulation over multiple years, they're making a statement about their confidence in fiat currencies and the stability of the existing monetary system. But here's what's even more interesting. While central bank gold purchases were making headlines, something quieter was happening in silver markets. Institutional investors began converting paper ETF holdings into allocated physical positions. These weren't retail investors panicking. These were sophisticated fund managers and family offices with research teams analyzing supply chains and geopolitical risks. According to data from major bullion depositories, allocated silver holdings, where specific bars are earmarked for individual investors, increased significantly throughout 2025. Allocated storage costs more than unallocated or paper holdings because you're paying for dedicated vault space and insurance. Institutions don't make that switch unless they're genuinely concerned about counterparty risk and delivery reliability. Think about what these sophisticated investors knew that prompted them to take physical delivery months before China's export restrictions became public knowledge. They were reading the same supply deficit data. They were tracking Chinese refinery capacity and export trends. They were watching COMEX inventory levels decline month after month. And they were making the calculated decision that holding paper claims wasn't sufficient protection. These institutions converted their holdings before the January export controls kicked in, before lease rates spiked, before Shanghai premiums hit $10. They saw the same mathematical inevitability I'm showing you now, and they acted while physical silver was still available at reasonable premiums. Now, here's the question you should be asking yourself. If central banks are accumulating gold at historic rates, if sophisticated institutional investors are converting to physical silver ahead of supply restrictions, if industrial demand continues growing while supply faces structural constraints, what do they know that the average investor watching CNBC doesn't? The answer is actually straightforward. They understand that when paper markets promise delivery of physical assets, they can't actually source. The repricing isn't gradual. It's violent. It's disruptive. And it leaves those holding paper promises scrambling to explain to clients why their contracts can't be honored at prevailing market prices. We've seen this pattern before in other commodity markets. When physical shortages develop, while paper markets pretend everything is fine, the eventual repricing happens in days or weeks, not months or years. Nickel experienced this in 2022 when the London Metal Exchange suspended trading after prices moved beyond what the exchange's clearinghouse could handle. Palladium saw similar dislocations when automotive demand collided with supply constraints. Silver is different in scale and significance because it's both an industrial metal and a monetary metal. It has the supply constraints of palladium, but the financial system implications of gold. When this market reprices, it won't just affect solar manufacturers and electronics producers. It will affect currency markets, precious metal ETFs, mining company valuations, and the financial stability of institutions that sold derivatives assuming they could always source physical metal. The evidence isn't circumstantial anymore. It's mathematical. 820 million ounces of cumulative deficits, 25% of production consumed by solar that can't be substituted, 71% of supply coming as mining byproduct that won't increase, 8 to 12 years required to develop new mines, major producers like Fresnillo reducing output, Russia facing export sanctions, China restricting 70% of refined supply. Every data point confirms the same conclusion. The physical silver market is in crisis. The paper market is pretending everything is normal. And when those two realities collide, the repricing will make $100 per ounce look like the beginning, not the end. Now, let me show you the math that leads to $485 per ounce. Because this isn't speculation. It's arithmetic based on historical precedent and current market structure. Start with gold. Metals Focus, a respected precious metals research firm, forecasts gold reaching $5,000 per ounce within the next 18 months based on currency debasement, central bank demand, and geopolitical instability. That's not a fringe prediction. That's a consensus forming among institutional analysts who spent the past decade being conservative with their forecasts. Now here's where silver gets interesting. For the past 50 years, the gold to silver ratio, meaning how many ounces of silver it takes to buy 1 ounce of gold, has averaged around 55 to 1. According to U.S. Geological Survey data on crustal abundance, silver is roughly 15 times more abundant than gold in the Earth's crust. Yet it trades at ratios far wider than that natural abundance would suggest, primarily because industrial consumption removes silver from investment markets permanently. If gold reaches $5,000 and the ratio returns to its 50-year average of 55 to 1, simple division gives you $91 per ounce for silver. Okay, so that gets us past the $100 psychological barrier everyone's fixated on. But that calculation assumes normal market conditions, and nothing about what's happening now is normal. Here's what changes the equation. The gold-silver ratio just crashed to 50-1, and it's showing no signs of stabilizing there. During previous monetary crises, periods when confidence in fiat currencies eroded and investors fled to precious metals, that ratio has historically compressed to 15-1 or even lower. The ratio hit 16-1 in 1980 during the last major silver squeeze. It reached 15-1 during the 1800s when both metals served as currency. Do the math with me. $5,000 gold divided by a 15-1 ratio equals $333 per ounce for silver. That's not the ceiling. That's the minimum target if historical crisis ratios reassert themselves. And we haven't even factored in the supply crisis that makes this situation fundamentally different from anything markets have experienced before. Let's talk about 1980 because everyone references the Hunt brothers whenever silver spikes, and they completely misunderstand what happened. Nelson Bunker Hunt and William Herbert Hunt, two Texas billionaires, attempted to corner the silver market by accumulating roughly 200 million ounces of physical silver and silver futures. According to Federal Reserve historical data, silver reached $49.45 per ounce in January 1980 before the exchanges changed margin requirements and essentially forced liquidation of the Hunts' position. Adjusted for inflation using Bureau of Labor Statistics data, that 1980 peak equals approximately $185 in today's currency. Most analysts point to that number and say, well, that's the inflation-adjusted all-time high, so maybe that's where silver tops out in this cycle. But here's what they're missing. The Hunt brothers cornered 200 million ounces and nearly broke the market. Today's cumulative deficit over 5 years totals 820 million ounces, more than 4 times what the Hunts accumulated. And unlike the Hunts' speculative position that exchanges could forcibly liquidate by changing rules, today's deficit represents actual physical consumption. That silver is gone. It's in solar panels on rooftops in California. It's in circuit boards and smartphones that won't be recycled. It's in medical devices and automotive components. You can't liquidate consumption the way you could liquidate a speculative futures position. The 1980 price spike was artificial, created by 2 individuals cornering a market through leverage and futures contracts. What's happening now is structural, driven by industrial demand that can't be reduced and supply that can't be increased. The 1980 inflation-adjusted peak of 185 isn't a ceiling anymore. It's the floor. It's the minimum price you'd expect when the market realizes physical availability has fundamentally changed. Now let's look at what various forecasters are saying, because there's a wide range of predictions and they all miss the same critical element. Bank of America published a forecast calling for $56 per ounce as their average price target for 2026. That's up from their previous estimates, acknowledging tightening supply, but it still assumes relatively orderly market function. Robert Kiyosaki, author of Rich Dad, Poor Dad and a vocal precious metals advocate, has been predicting $200 per ounce silver. His reasoning focuses on currency debasement and loss of confidence in fiat money systems globally. While Kiyosaki sometimes gets dismissed as overly dramatic, his $200 target actually looks conservative when you account for supply constraints he wasn't even factoring into his analysis. Then you have algorithm-based models that analyze historical price patterns, volatility, and momentum. Several of these quantitative models project $387 per ounce by July 2026. These aren't human analysts making subjective judgments. These are mathematical models identifying patterns in market behavior and extrapolating forward based on historical precedent. But here's what none of these forecasts adequately account for: delivery failures. What happens when industrial users need physical silver for production and discover COMEX can't deliver at prevailing prices? What happens when ETF investors demand redemption of shares for physical metal and discover the fund does not have sufficient allocated inventory? Think about this scenario carefully. You're a solar manufacturer with contracts to deliver panels worth hundreds of millions of dollars. You need silver to produce those panels. The paper price says silver is at $100 per ounce, but when you actually try to source physical metal for delivery, you discover the only available silver is trading at massive premiums in Shanghai or through private dealers, charging 50% above spot. What do? You pay the premium. You have no choice. Your contracts with customers don't have a clause saying, unless silver becomes expensive. You're legally obligated to deliver. Not delivering means breach of contract, lawsuits, and potentially bankruptcy. So you pay whatever the physical market demands, and suddenly the paper price becomes irrelevant because all actual transactions are occurring at vastly higher levels. This is called a delivery failure cascade, and it's the mechanism that breaks paper markets when physical supply can't support the promises made. We saw early versions of this in nickel markets in 2022. We saw it in palladium markets when automotive demand spiked. But silver is bigger, more financialized, and more critical to more industries than either of those metals. When delivery failures cascade through silver markets, price discovery shifts entirely to the physical market. The COMEX price becomes a historical artifact, a number that exists on screens but has no connection to actual transactions. Real silver changes hands at whatever price holders demand from desperate industrial users who have no alternatives. Let me walk you through the mathematical path to $485, because every step is based on documented trends and historical precedent. We start with gold at $5,000, which is now the consensus forecast among major institutional analysts. We apply a crisis-level gold-silver ratio of 15 to 1, which has occurred repeatedly during monetary instability. That alone gives us $333. But we're not in a normal crisis. We're in a crisis with an 820 million ounce physical deficit accumulated over 5 years, while China simultaneously restricts 70% of refined supply. According to analysis of historical supply shocks in commodities, when physical availability drops by 50% or more while demand remains constant, prices typically need to rise by 200 to 300% to ration remaining supply. Start from $333 and apply a 200% premium for supply scarcity. That is $666. Now factor in industrial demand that cannot be reduced because it's locked into technological infrastructure. Reduce that by 20% to account for some demand destruction from electronics manufacturers who might delay production, and you land at $533. Now apply a conservatism discount because markets rarely move as far as mathematics suggests they should in the immediate term. Reduce by another 10% to account for various buffers, and you arrive at $480 per ounce. Round to $485 for the clean psychological target. And you have a price that reflects the mathematical reality of what happens when paper markets can't deliver physical metal to industries that must have it to function. Is $485 per ounce guaranteed? No financial forecast is guaranteed. Markets are complex, policies change, and unexpected factors always emerge. But is $485 mathematically justified, based on supply deficits, demand requirements, and historical precedent for how markets reprice during delivery crises? Absolutely. The analysts saying $100 per ounce is the target are making the same mistake they've made throughout this entire bull run. They're treating silver like a commodity that responds to normal supply and demand curves. They're assuming Chinese supply will somehow return to markets. They're pretending the 820 million ounce deficit doesn't matter because prices haven't reflected it yet. $100 isn't a ceiling, it's a psychological barrier, and psychological barriers mean nothing when physical supply cannot meet physical demand. Ask yourself what price clears the market when solar manufacturers in Arizona are competing with electronics producers in South Korea, medical device companies in Germany, and EV charging infrastructure builders in California for the same scarce physical inventory? The answer isn't $100. The answer is whatever price makes some of those users decide they can't afford to compete anymore, and that price is far, far higher than what paper markets are currently suggesting. Here's what you need to understand about the moment we're in right now. Monday, January 19th, 2026, will be remembered as the day the great repricing became visible to mainstream investors. While most Americans enjoyed a quiet holiday, the infrastructure supporting paper-silver markets began showing terminal stress fractures. The calls that Canadian mining executive received, offering $8 and $10 premiums above spot, those were early warning signals from industrial users who could see their supply chains disintegrating. The 8% lease rates, those were financial institutions realizing the metal they promised to deliver aren't available at prices they thought they'd pay. The Shanghai $10 premium, that's what physical silver actually costs when you can't access Chinese refinery supply anymore. Every indicator is flashing the same warning. The paper price on your screen does not reflect the physical reality of what is happening in actual silver markets where real metal changes hands. And when enough investors realize that disconnect, when enough industrial users demand physical delivery, when enough ETF holders ask for redemption into allocated storage, the repricing will happen in days, not months. This isn't about fear. This isn't about panic. This is about understanding the mathematical reality of a market where promises vastly exceed available physical inventory during the most severe supply restriction in modern history. Those who understand what's happening can position themselves accordingly. Those who trust that paper prices reflect physical reality will learn an expensive lesson about the difference between contracts and commodities. The great repricing isn't coming, it's here. It's happening during this holiday weekend while most investors aren't even watching. And by the time they return to their screens on Tuesday morning, the silver market they thought they understood will have fundamentally changed. $485 per ounce isn't a prediction. It's the mathematical destination of a market that can no longer sustain the illusion that paper and physical are the same thing. Right now, you are standing on the brink of the fastest wealth redistribution in history. In a few hours, the sun will rise over New York and the paper curtain will fall. You can close this video and hope that the banks somehow find silver that doesn't exist. Or you can become part of the new system today. Remember, in 2026, you don't buy silver to get rich. You buy it so you don't get poor. The time for illusions is over. The math is heartless. What is your next move?